All right, good afternoon, ladies and gentlemen. My name is John Bringardner. I'm executive editor of Debtwire, and I'm thrilled to be here at FII today with my distinguished panel to discuss a very big question. How can expanding retail access to private markets democratize capital? Now, at Debtwire, we cover nearly 50,000 companies around the world, the majority of which are private. We see in our reporting every day that there's tremendous upside in these investments, but also tremendous risk. Meanwhile, providers of private capital are increasingly tempted to explore retail investor markets as they seek to broaden their investor base and access to new capital. Now, with so much at stake for retail investors, how can you build trust in private markets that have a reputation for being opaque, complex, and favoring insiders? What steps are needed to bridge that trust gap? How will this trend democratize capital? Now, to discuss these ideas, I have with me today 4 investors from across the GCC and Africa. I have Mahmoud Adi, founding partner of Shorooq Partners, Huda Al Lawati, founder and CEO of Aliph Capital, Fadi Ghandour, executive chairman of Wamda Capital, and Ibrahim Sagna, executive chairman of Silverbacks Holdings. Now, I'd like to start with you, Huda. Let's start unpacking some of our assumptions here. Why is access to private markets for retail investors a good idea?
Yeah, thank you. Thanks, everyone, for being here. Can't hear me? Can you hear me?
Yes, no. There we go.
Thank you, John, and thanks. It's great to be here. So, look, I think first of all, the question is that what are we talking about when we say retail access? We obviously don't mean having the regular Joe sign up to private market products. What we mean is that the wealth in the sort of lower end of high net worth individuals is increasing. It's, by estimates, depending on who you believe, is anywhere from $30 to $40 million. But these are not institutionalized pensions or institutionalized family groups that have access to private markets, and their allocation to private market remains very low. So does it make sense? And I think the logic behind it is over the years, if you look at institutions, particularly endowments and institutions, they've increasingly allocated more capital to private markets. The charge started with the likes of Yale Endowment, and today you go up to 35, 40% with endowments, over 20% for many of the pensions, averaging over 15% for institutions, and that has resulted in higher returns. With 10% in the public markets versus 13% for somebody like Yale, who has a very, very overweight allocation to private market. So of course it makes sense to allocate capital, and that's the logic of trying to open up these opportunities and allow access for a bigger pool of people to make money through these products.
Mahmoud, you have primarily institutional capital in your funds. What would it mean to have access to that wider pool that could come from the retail investor market?
Yeah. So first of all, great to be here, and thank you, John. As a financial investment kind of company, at the end of the day, you kind of look at two-sided market. One side is the capital, the source of the capital, and the second side is the deployment, right? And I would say in a growing market like the Middle East, technically what we are seeing, there is a lot of opportunities on deployment side, but there is a bottleneck in the source of capital, especially for alternative, I would say. Now, traditionally at Shorooq, probably 80–90% of our capital has been institutional capital. And the idea of opening that for kind of qualified high net worth individual will be a fantastic idea. Now, the problem usually is about distribution, access, education, regulation, right? But the reality is, to Huda's point, is private market globally has proven to generate alphas for investors, right? And in our market, there is not a lot of participation from these private investors. Usually, private investors hold assets and operating companies. But if they want to invest in alternatives in the region, that is a challenge, right? So it will be a fantastic opportunity for people like us to be able to tap into that pool of capital.
And Ibrahim, we were talking about this earlier. To you, what is the retail investor? I mean, we have your mom and pop investors, you have family offices that have more sophistication, more resources, but at the end of the day, can you treat them like a retail investor as well?
Yeah, first I'd like to thank the Kingdom for the invitation. It's always a spectacular opportunity to be here. I think it's important to contextualize the issue because I think it gets viewed as a problem when really it is a solution. Because when you go at the origin of the phenomenon, which is really in the US, what you have to look at is that governments need to finance projects. And if you look at the globe, whether you're in the US, Africa, or Middle East, the bulk of the projects to finance are around new economy. And new economy, what is it? Data centers for the cloud. It is higher internet speed. It is also transition energy. And all of those require long-term capital. And the financing used to be done by banks. A lot of us are former bankers. And then you realize that bankers, at the end of the day, they really capture short-term capital from savings money, but then pretend that they can do a good job in terms of financing long-term. And we all know that from a regulator standpoint, that creates a massive mismatch issue. So over the years, as retail has been gaining greater access and wealthier people have been structuring family offices, it enabled a matching principle that started obviously in the US, but in this side of the world where you're getting a plethora of family offices coming to bear every year, it's really an opportunity for you to start helping finance the economy. So I think that context is really important to see. But one key point that has arisen is that obviously regulators need to protect the retail investor because at that segment, you have a lot of lack of sophistication. Education is scarce in terms of understanding the asset class because of the variety of products. So when in the US this phenomenon started, you have to see that probably phase one was the banks losing a bit of their lunch to the investors' sophisticated investment platform because those were coming and were able to give money from endowment, money from family offices, and they were providing longer capital. So in our specific case, we're lucky because most of our investors have historically been family offices. And what we've always been careful about is thinking about the issue of alignment. Because even in the arrival of the retail coming into private, it's fundamentally about aligning the long-term maturity of these projects and the patience that capital. The reality is if your goal is immediate liquidity, public market needs to remain your home. If that is not a problem, I would argue that the private markets are actually more transparent and a better option because the misconception you tend to hear is that public market is more transparent. But if you take the credit side of private market, those transactions get rated from A to B. They also get reviewed, they get audited. So fundamentally, you get a wider set of products. So I would argue if over time we realize that private market is a bigger opportunity, is more diversified, and provide a level of transparency, the only condition the retailer needs to look for is that they don't require immediate liquidity, and second, can make sure that they get the proper education to understand the different credit risk. But it's definitely a bigger opportunity.
Is that how you see it, Fadi? Is this a...
No. No, I'm going to question the concept of the democratization process for private markets. I think the way to do it, you can. I mean, one needs to ask, the first question that needs to be asked is why? Why do we want to bring in retail investors into a market that is quite complicated and quite different from what they are used to? There are public markets out there. If you want to get access, you can go to the public markets. I think what the regulators should do is widen the markets, deepen the markets, and make the markets easier for people to go public so that, and then the public can actually participate in these markets. But the question is, why would VCs, and I used to be a VC, want access to the retail market? It is going to be a nightmare to manage that unless there are mechanisms and vehicles to do that. Now, there are platforms that are coming up now, tech platforms that are about to be regulated. The regulator still doesn't know how to deal with them, but there are some that are out there that allow you to have the VCs want to, or the founders want to list their companies and enable some exits or some secondaries to come out to be sold to people who want to be in these private markets. But there is also a myth about this sexiness of this industry that is private, meaning specifically in the VC I'm going to talk about. So the VC industry is an extremely patient capital industry. The retail investor, I can tell you from now, has no patience. And if the retail investor is going to come and become an LP, or I don't know what vehicle it is, and you're going to tell him you're going to wait 7 to 9 years to get your exit, because the minimum exit time is going to be 7 to 9 years. And that is going to create a problem for the GPs, for the managers, and for the investors themselves. So the question that needs to be asked, and I will end here, is what is the purpose of democratization? Is it to spread the wealth? Is it to give them access to, because the family offices, if you want to go back to family offices, they have access to everything they want, right? And if they want to get into any asset class, they will have the sophistication eventually. They can acquire knowledge from people that they will recruit who will give them that access, or they can go through their banks who can give them access to most of the funds will do that. So, but if you want to go retail, really retail to the average individual out there, I think that needs a lot of thinking. And I think you need to think of the market as a whole and what's happening in it rather than that specific thing that needs to happen.
In the last plenary session, Mark Rowan of Apollo, I believe he said something like, in 18 months' time, public and private markets will look the same. And now to you, it sounds like more of a warning than an opportunity, perhaps. But if we stick with that technology, those platforms that give access to private capital, to private markets, what should those look like in an ideal space? Huda, what are the platforms that exist now, or what are those that could come to be that would do this in a fair way?
So look, I mean, before answering what the platforms should look like, I think we should maybe structure out a lot of what has been discussed is what are the challenges we're talking about, right? I think first, we're not talking about, again, giving access to the regular Joe. We're talking about giving access to people who still have, at least $1 million of disposable or investable income. And look, it's not new as well, right? Blackstone has made a lot of headway in doing this as well. They recently launched a Blackstone private equity fund that reached, I think, $1 billion. But the point is that you need to address the challenges. And if you see them, we talk transparency, whether that's perceived or actual, it's a challenge. There's an opportunity there for gatekeepers, for rating firms to create a system whereby people can actually understand how to rank these products. And embedded in that is the point of, well, it is higher returns potentially, but there's a lot of dispersion in that, right? It is the top quartile that really get that returns. It's not all over the place. The second, and I think the biggest challenge that you see for investors of this ilk, even if they are wealthier individuals, liquidity is a challenge. So you need to do a bit of structuring around that. The Blackstone private equity fund has created liquidity windows that has an impact on the investment strategy and the kind of returns you target as well, therefore. The third challenge is the cost of distribution. This is what technology can address, because it makes sense for me to hire a sales team or an investor relation team and a capital formation team to go and get a $10 million ticket, but it does not make sense for me to do that to start getting smaller tickets. So what's the best? It's an aggregated type of situation where you need a tech platform. I've seen a lot of well-tech platforms. They have great UIs, UXs. They don't have the regulatory halo, and they don't necessarily have the product kitchen behind them, but that needs some work. Another challenge from the GP perspective is committed capital. If you go down the retail side and you have a 4-year investment period, you're going to have an incredible number of defaults, because we rely on an institution, a sophisticated family office, writing me a check 3 years after they made the decision to invest. You can't do that. But a couple of finance people in a room can probably structure around that. And finally, there's the regulatory element. Who qualifies? And I think this is to Fadi's point. There are accreditation platforms out there, tech platforms. There are self-qualifications. You do need the regulator to probably play a role. And that's, I would say, a dangerous space, to Fadi's point. And you have to be careful in who actually gains access through this. You don't want the person who doesn't have the capability, the sophistication, or honestly, the right investable capital. They may be doing their investing from their savings, and VC or private equity in GCC is not really where you should start putting your capital. I would not accept that capital. So I think there's all these challenges that have to be addressed. There's a combination of regulation, intermediation services, aggregator, but also a level of responsibility that comes with it.
Is that how you see it, Fadi? Is it creating a threshold of access for a certain level of investor, or is there a space for two tiers?
Let me say that, let me add something first, that retail investors, or let's call them early stage, very early stage, or family and friends type of people, are already getting access through angel networks that get them to enter very early stage. So there is an asset class that exists out there. There are people who are going out and investing in companies directly, not necessarily in funds. And there is that. So they understand the risks that come with it. And there are plenty of clubs and plenty of angel networks across the region. And I think they're essential because they serve a specific purpose for the very early stage companies that are not going to get access to institutional money early on, nor do they want to get access to institutional money. It's higher risk, but it is also an asset class that is reaping rewards, because these are the first people, I know I'm adding another point here, these are the first people that are getting their money back nowadays. Because specifically as you go into later stage funding, you're finding that a lot of the very early stage angel investors getting their money back. But these are people that understand the risk. But democratizing it much more than that is where I find the challenge. But I do agree with Huda's point.
And maybe, Fadi, helpful to kind of define what is a retail investor. I don't believe that.
Yes. So let's define.
Believe someone who has like 10,000, 50,000.
No, correct.
Should
but
be
who is then?
Right? For me, is like not.
And who will define it? Who will define it anyway?
Usually the regulator should be defining it, right? But we're talking about people who have, let's say, half $500,000
to invest.
To invest outside all their kind of need, right? So people who have money today, they are busy running their stuff, whether they are employee or they have their kind of craftsmanship or whatever that business that they're running, right? These people usually today, structurally, they don't have an advantage to access private capital or private opportunities.
Correct.
And the unfortunate, I would say, reality is, and that's where I think technology can help. If you create a product that gives them access to everything, then they are indexing, then they're losing the opportunity of making alpha from the private.
Correct.
How do you create a product that gives them the opportunity to invest in a sophisticated manner in the right opportunities for them? That's what we need to solve.
So that's where angels also sit then, right?
Yes, but I think the point is that the reason Yale Endowment made outsized returns by allocating increasingly to private capital is because they had access to top quartile funds like Blackstone and Tommy Brown and whatever it is, right? I think that's the level of fund or an opportunity that doesn't make its way to the guy who is wealthy, has $1 million to invest, but he may have access to angel networks and sitting in UAE to mine and Mahmoud's fund, but they're not getting that opportunity. So how do you create that funnel?
Okay. I get that.
I would even fine-tune our definition to say that it's an individual that's ready to lose $1 million. That's really the best way to look at this group of people. Yeah. And in our own backyard, what we do is beyond that requirement, we actually try to find a way to match the appetite. I think every regulator that looks at that space needs to make sure that the intermediary, the manager, the fund operator is giving some substantial disclosure in the space of risk profile and maturity for a possibility of capital gain. One extra layer we put is our specific space of intervention is actually technology like everybody else, but we expand it to entertainment and sport. And the parties we bring are actually family offices of former athletes, former Grammy singers, former movie producers that actually understand the space. Because another mismatch or arbitrage that we've seen is that whether you have an actor, an athlete, or musician, their lives is different to ours. We tend to follow an academic trap where the income grows gradually. They get a sudden bump of abnormal income and a sudden collapse. And during that short maturity, they have limited knowledge around them to help them manage. So when they fall off the cliff is hard. But this new generation is actually a lot more sophisticated. So we have former Grammy singers, former NBA players as investors. Some of them, they're just starting their career, but they already have like 5, 7 advisors that are building the next decades for them. So that's a powerful set of retail investors that you cannot ignore. Now, what we provide them is actually an asset class and a sector they actually understand operationally. It's not like we're telling them, go and invest in a 401k or an ETF. We're telling them there's something about your current industry we're looking at, park the money, but we welcome your point of view. So you actually get an engagement level that you don't get in your typical asset management. So that alignment created extra buffer of safety, transparency, information sharing that also benefits this side versus just the other side in terms of protection.
Well, so we've talked a lot about the source of fundraising or the potential for fundraising from retail investors, but I'd like to touch on, while we still have time, the origination of deals. If we're talking about greatly expanding this pool of capital, there are a lot more funds to be deployed, and we're already chasing a lot of deals out there in the market. How do you find new deals to tap into the funds that are coming through? How are you finding the big deals that the Blackstones and the Apollos are doing, and then the smaller deals that in local markets might make sense? How do you fill this potential fundraising boom?
Is this at a fund level? Is this a retail level? At what level?
Well, what level? I think there's a lot of private capital that's available now for the big ticket items. The Apollos of the world that have $500 million to drop. But once you go down market, if you're looking for a $100 million deal, a $25 million deal, are those the kinds that you're doing, that you're seeing? Are you able to find those to fill the demand from?
So I think that just maybe clarification, raising retail money doesn't mean you're doing smaller deals, right? This is just creating a funnel towards it. Could be big funds, it could be growth funds, it could be VC funds. It's just a funnel, right? The strategy choice will remain the same. I think we then get into another topic of the broader question of there's already a lot of undeployed capital committed with these large PE houses, and private equity allegedly sits on trillions of dollars of undeployed capital. And the question, if you bring more capital into that space, where are the opportunities going to come from, or is it going to impact valuation? And I think the reality is that where we sit from, and I think that's where we can answer, for we sit in a lot of growth markets. Private capital asset classes are untapped, underpenetrated. The ability to benefit economies and companies by channeling private capital into the broader economy is still not as explored. So I think there's an incredible opportunity, but at least where we sit.
I agree with that.
So in our case, we were lucky to explore a path 5 years ago that has bared massive fruits, where we felt that shopping for secondary proposition in a forest of spectacular VC managers is the best approach. So we backed 9 VC managers. We've added them over time to an investment program. They're probably the most active. So over time, each of them have performed, but what we've done is when we compare their own performance, their own exit, and our own singular, we beat them. Because what we do is we treat ourselves almost like a university and them as the high school. We basically graduate their best situation that gives them DPI, but you are pretty sure that you're getting a highly de-risked proposition that tends to be followed by many and that probably is more advanced on the revenue channel. And because it has gone through that journey, it's probably easier to sell off when it's time to do your exit. So the reality is the higher gain is still on early stage. The liquidity opportunity is still on early stage, but the risk is massively bigger there. So what you want is to work with an army of people that do spend more hours in that problem so that you can offset that risk, take a smaller level of gain, but be guaranteed return to an extent.
Mahmoud, is growth capital, is that the opportunity in the Middle East?
I believe the opportunity of capital deployment here is across the stack.
Yeah.
From the early to the early growth to late growth, like the names or the money that you're talking about, the kind of the billions of dollars, if you look at it, where it has been deployed in the region, most it has been deployed with government-backed entities, right? It does not trickle to the private sector. So today there are, I would say, so many gaps across the capital stack, whether it's a private equity, whether it's a credit opportunities, whether it is early stage, venture, all of that stuff, right? And that's where I wanted to also kind of come back to a point we discussed earlier. I fundamentally agree with what Fadi was mentioning. We need to make the path to liquidity IPO market easier generally, because that's a clear pain point for all of us in this market, right? And we see different initiatives across different countries in the region, but we want to see more, right? But at one point, once that market hopefully become more developed, etc., you would have great companies that make a choice. Do I want to go public or I want to stay private, right? Today, because we don't have the public option, one of the successes that you look at is me going public. So it is, if you are doing well, it is kind of implicitly expected or explicitly expected to go public, right? But in a scenario where there is an active public market, active private market, you make the choice as a founder, right? And that kind of create a market opportunity for, let's say, the high net worth individuals who've been kind of missing on some of the private opportunities, kind of going back to the kind of access point. The other behavior that we have seen also in the region for companies that are going public outside the tech sector, because there hasn't been a lot of tech companies going public here, sometimes IPOs are priced at fairly kind of good value, right? Which means there is not a lot of actually upside for the retail investors who's coming at IPO, right? And that kind of trickle back about like, okay, are we missing value for all those people?
And I think that's why actually I disagree with both you and Fadi. I don't think IPO is a solution for our region. Because if you look at most of the IPO that has happened on the African continent, Middle East, Swivel, you go on the list.
No, IPO in our local markets. Not
okay,
going
all right,
global.
Yes.
No.
IPOs.
Okay, so don't go international. All right.
Go international when you have a robust company. I took my company public on NASDAQ and we did very well. But don't go prematurely to a market that does not understand you and the business model that is not clearly defined first. So that let's not take what Swivel did as an example. It's a terrible example. But what I am saying is we need to open up our own markets here, make them deep and have higher liquidity so that the retail investor can come in and come out as quickly as they need. Institutional investors can come out and you can bring the global funds.
And pricing them well for the retail investors as well.
I mean, that's the problem here. We still have relatively too many markets that are not big enough for you to have one, liquidity, and number two, get the proper regulation so that people can go public much easier than they have now. Because the tech ecosystem, by the way, has only 1 or 2 companies that have gone public in the region. So, and that's why Swivel went public on NASDAQ probably. But we need our own markets to say, you are most welcome. We're happy to listen to you, to see how the regulation can fit people that are growing and building their business in this region, so that we don't lose our companies to go somewhere else.
So
we're done.
That's a great final pitch, Fadi. We're going to synchronize the regulatory markets.
Got the last word. All right.
Find investors. But thank you so much to our panel. Thank you all for listening, and I hope you stick around for the rest of the afternoon.